Good afternoon, everybody. Thank you for joining us today. My name is Andy Umback. I'm a wealth advisor here at Pulse Financial Services. And first, we'd like to start off congratulating everyone on surviving the first quarter of 2026. So certainly been an eventful quarter. Even as we try to make sense of this first quarter, we need to survey the financial landscape entering the second quarter. So here are some of the thoughts on the economy and the markets using, 10 different slides from the guide to the markets. So I'll kind of go over 10 different points of what we're seeing and what's to highlight for the upcoming quarter, certainly. Higher oil prices, as you may have heard, will temporarily increase inflation and worsen some of the inequality that we're seeing in the economy, but they shouldn't push the economy into recession. The most dramatic event of the first quarter was the joint U.S.-Israeli attack on Iran. As this is being recorded, it's still very unclear how this war will end. That being said, the U.S. administration is under increasing pressure to find an off-ramp given a declining U.S. stockpile of offensive weapons, in particular defensive weapons, and the rising economic damage from the conflict. If, as we expect, the conflict ends fairly soon, energy prices may still remain somewhat elevated for months to come, with mixed implications for the U.S. economy, as we show on page 31 of the guide. The conflict has pushed gas prices to their highest levels since 2022, and this could boost the year-over-year like CPI inflation, the consumer price index inflation rate. It might hit around 3.5% by May or June in kind of short-term pain. However, the oil shock is unlikely to push the U.S. into recession since, in contrast to oil price spikes of previous decades, the U.S. is now a net exporter of oil. So that can shock some people. We actually export more oil than what we import, so we're a huge energy producer. This implies what domestic consumers lose from their oil prices, domestic oil producers will gain. That being said, gasoline and energy in general absorb a much larger share of income of lower and middle income households than wealthier households. Because of this, higher oil has adding, already serious problems of affordability, potentially hurting the spending into consumer basics and contributing to a negative public mood heading into these November elections. So oil, obviously a huge hot topic in the first quarter and continuing on. So lower net immigration will hurt the economic growth, but its impact could also be partially offset by AI capital spending. Data released in the first quarter shed significant light on the long-term outlook for the U.S. economy, both in terms of demographic headwinds and technological tailwinds. On the positive side, productivity in non-farm business sector rose by 1.7% in 2025, following strong gains of 2.1 and 2.7% over the prior 2 years. As we show on the right-hand side of page 21 of the guide, output per worker has risen faster than this decade than in either the 2000s or the 2010s. This productivity surge has been aided by a sharp increase in capital spending on intellectual property and R&D, a trend that is likely to continue in the years ahead as companies race to take advantage of the AI revolution. On the negative side, the very sharp downshift in U.S. immigration over the past year, combined with continuing aging of the baby boom, suggests that the working age population is now shrinking. Given that we are starting from close to full employment, this suggests that essentially all the economic growth in the second half of the 2020s will have to come from productivity, a trend that could well limit long-term U.S. economic growth to less than 2%. We expect economic growth to pick up this summer due to the strong income tax refunds that a lot of people have been receiving. Maybe fall back towards 2% later in the year. Returning to the short-term, outlook, we expect relatively slow economic growth for the start of 2026, a pickup in the middle of the year, and a resumption of slower growth by the end of the fourth quarter. This forecast is based on an expectation of fiscal stimulus directed at the U.S. consumer. The first dose of the stimulus will largely be received by consumers in April and May as tax cuts enacted last July lead to stronger income tax refunds. So a lot of people are starting to see that. A second dose could be received this summer if Congress enacts the so-called tariff rebate checks ahead of the November elections. However, if in November the Democrats win a majority in the House of Representatives, they would likely they would be unlikely to support further unfunded tax cuts or spending increases that could give a political advantage to the Republicans. Consequently, expect fiscal stimulus to wind down or even turn negative in 2027, restraining overall economic growth despite our continuing AI capital spending boom. Job growth will likely remain very weak. However, the unemployment rate should also remain very low to the very low net immigration. Benchmark revisions to the establishment survey and updated population controls applied to the household survey mean that the government's two main jobs reports are both showing stagnation in job growth, with payroll jobs just rising 0.1% and unemployment, as measured by the household survey, actually falling by 0.3% over the past year. Despite continued economic growth, we expect job gains to be lethargic in the year ahead, with roughly 50,000 payroll jobs added per month. This reflects both a lack of available workers due to the changes in immigration policies and solid gains in productivity. However, this lack of labor supply also means that the unemployment rate could actually fall to the end of the year to around 4%, down from its current 4.4% rate. While the labor market isn't strong, it is tight. In addition, despite labor market tightness and higher CPI inflation in the first half of 2026, we expect only modest wage gains as companies hesitate to raise wages in an uncertain environment. This makes it much less likely that cost push inflation will take hold in the US economy. Year-over-year inflation could peak around 3 or 3.5% this summer due to the higher oil prices that I mentioned. Tariffs and stronger income tax returns also can contribute to that. However, like we mentioned, it could retreat later in the year as these impacts fade. We expect that year-over-year inflation rate will rise over the next few months, potentially hitting at 3.5% in June, reflecting the higher energy costs and raw materials and the Iran conflict. Um, but however, inflation should fade quickly in the second half of the year, dragged down by slightly lower level of tariffs after the tariff ruling, steadily falling housing inflation. So we're seeing inflation and rents come down a bit too, reflecting slower rent growth. In turn, reflects weaker immigration as well, so that could help bring inflation down if there's less demand out there, of course. Going into 2027, year-over-year CPI inflation could well fall below 2% as these trends continue and comparisons with the year's energy prices become much easier. Now, it's important to remember that when we're talking about inflation getting lower, we're not talking about deflation. We're not talking about costs, getting cheaper. We're just talking about costs rising slower. So sometimes that can get confusing. Oh, inflation's down. It doesn't mean, our menu items are going to cost less. It just means they're going to rise at a slower rate. Because inflation's coming down, we now expect the Fed to cut, just once this year, although we could see more significant rate cuts in 2027 if both inflation and real GDP growth fall below 2% entering 2027. Futures markets at the end of 2025 were pricing in two Federal Reserve rate cuts this year. However, 3 months into the new year, both of these projected rate cuts have disappeared to be replaced by a small risk of a Fed rate hike potentially. Projections of a more hawkish Fed, meaning more likely to raise rates, are understandable given the apparent resilience of the economic growth and the additional inflation from the higher oil prices. In addition, the Fed has demonstrated strong resistance to political pressure to ease, just to cut rates. That being said, we think markets are probably pricing in a more hawkish Fed than the data will eventually justify. While we don't currently expect any rate cuts before December, if both inflation and economic growth slip below 2% at the end of the year, we could get a rate cut, the last meeting of 2026 and a few more in 2027. So it's interesting how that dynamic can change, month to month as different things impact it. Bond yields look close to fair value, arguing that the neutral, allocation rose modestly in the first quarter, likely reflecting the temporary inflation shock. So, like we're saying, inflation's supposed to come down, or it is coming down. The Fed could cut rates, so we'd expect bonds to do well. So if inflation and rates are going down, bonds could do well. Well, bond yields actually went up a bit, which was a challenge for bonds so far in the first quarter because of higher inflation, because of higher oil prices was the reason that rates went up a touch. But meanwhile, credit spreads widened on recession fears and potential spillover effect from private credit worries. But even now, with some higher bond yields, there's still a strong argument for making a bet on either side of, on the either side of the bonds. If the economy weakens, any rally on bonds should be limited by the Federal Reserve borrowing and against stubborn inflation. In the short run, we expect the economy to avoid recession, justifying, the higher rates currently. However, we do think that roughly normal bond allocations make sense in this environment. Historically, at today's close, a 4.7% yield on the bond index fund has been closely associated to a 4.7% annual return over the next 5-year period. So that's kind of an interesting way to look at some of this. And if we're expecting rates to drop, we're going to see more CD rates potentially come down, savings and money market rate come down. So some of these bonds could be a nice hedge to against declining or stable rates. This is another chart that I like to go over with all of our clients in the meetings, is just kind of seeing, well, where is the market? How expensive or how cheap is it? And valuation is not a good predictor of what the market's going to do over the next month or week or year necessarily, but it's a good driver of what we can expect from returns going forward over the next, 5 and 10 years. And what this chart's showing is that large cap US equities, they're still expensive relative to their own history and the rest of the market. One anomaly entering 2026 was the continued outperformance of the largest companies in the S&P 500, both in terms of earnings and equity market gains. Much of this reflects the dominant market position of US tech firms and a surge of interest in and the investment around artificial intelligence. That being said, in recent years, the stock market outperformance of these companies has generally outpaced their outperformance in earnings, leaving their valuations at high levels relative to the rest of the market. This anomaly persists today with the top 10 companies in the S&P representing close to 40% of the market value of the entire index. I'll repeat that, the top 10 companies of the S&P 500, so 500 companies, 10 of those companies account for 40% of the market value. So that's pretty stretched. For long-term investors, it may make sense to increase allocation to other parts of the market that are, less economic or geopolitical sensitivities. And, certainly those things can turn a mega cap US equity boom into a more challenging time ahead. So always important to be diversified, especially when pockets of the market are more expensive. International equities still look attractive relative to the US market, even if we ignore an overvalued US dollar. In 2025, international stocks sharply outperformed their US counterparts as local currency gains were amplified by the impact of a falling dollar. So again, just dollar going down can bring international profits, higher. In the first quarter of 2026, despite a rally in the dollar, non-US stocks still narrowly outperformed US stocks. Still, it's been a close, perhaps causing some investors to wonder if 2025 was a flash in the pan for international stocks. We don't believe so for three reasons. First, even after a 2025 rally, non-US stocks still carry much lower valuations than the US stocks. Second, the dollar remains very overvalued given our trade fundamentals, and we expect it to fall in the years to come. And third, given the outperformance of US stocks over the last decade, most US investors are likely very underweight international stocks relative to an appropriate long-term asset allocation. And as they reallocate some funds to international, this on its own should boost relative returns to the international side. Alternative investments, so alternative to just stocks and bonds, can add total return, income, and diversification to portfolios. The last few years have seen very strong stock market gains. However, that outperformance could limit future returns. Moreover, the traditional role that bonds play in zagging when stocks zig has been challenged in recent years by higher inflation, which negatively impacts both stocks and bonds. In this environment, many investors are exploring alternative assets such as private equity, private credit, infrastructure, real estate, buffered investments. These assets are all quite different. Some provide strong long-term returns, some generate strong income, others act as a good diversifier or downside protector to publicly traded stocks and bonds. Many of them are, some can be quite illiquid and so should be thought of as a long-term investment. Moreover, the performance of different assets within the alternative space have varied considerably depending on the manager. But still, perhaps adding alternatives to a traditional stock bond portfolio may make sense for many investors as we expect this area of financial markets to continue to grow in the years ahead. It should be noted, finally, that while alternatives can play a defensive role in portfolios, they can also be used for offense, allowing investors, for example, to participate in the AI theme through smaller private firms building new AI applications or generating the electricity necessary to develop them. However, more broadly, alternatives and international equities can both play an important role in rebalancing the portfolio. This is important since after 3 great years of U.S. equity markets, investor portfolios are not just significantly larger, but also are more risky and more concentrated than most participants intended. And consequently, and particularly in a very volatile geopolitical environment, investors should consider whether they need to rebalance and how to do this in the most tax efficient manner. So we hope you found this information helpful. And where would we be without our lawyers and all this important disclosure? Certainly reach out to us if you do have additional questions or would like to review how some of these themes could impact your portfolio or how to take advantage of some of these themes. We wish you a good rest of the week.